I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialist, Paul Robson. So today we have a currency exchange Bondcast crossover to talk about recent market events. Of course, we have also had a US holiday, so it's a great timing for that. So let's start with you, Paul. We just had the Bank of England decision with a no-cut scenario as expected. How does that impact your views?
Well, in terms of today's Bank of England decision, not a lot was expected, not a lot was priced in, and it delivered on those expectations. So, obviously, no change in rates, and the important parts of the decision looked also in line with market expectations. This was a sort of interim meeting. There wasn't a monetary policy report, so we're left just wandering through the minutes and also then just thinking about the vote count, which was 6-3 in terms of keeping rates on hold, 3 dissenting voters for a 25 basis point cut. That was slightly more dovish than we had expected. We thought there'd just be 2, but Ramsden had decided that he wanted to lower rates at this meeting. In terms of the important part, that's always about the hints about where policy might be going, so the guidance, and that was left unchanged. So that the Bank of England still thinks that interest rates will come down in a gradual way, in a careful way. Together, I think that just keeps them as a sort of cautious, cutting central bank, which they have been through the cycle. The market impact was rightly fairly muted. I think markets took it as a slightly dovish meeting overall, perhaps just because of that vote count. So just 5 basis points lower in end of year pricing compared to the day's highs, and a couple of basis points off the previous day's close. My colleague Asta was very diligent. She went through the minutes to count the number of times that uncertainty had been mentioned in this set of minutes compared to the previous sets, and she noted there were 13 mentions of uncertainty or uncertainties. That was up from 9 in May, but still down on March of 17, when I think we were getting peak tariff uncertainty. So in some ways the outlook has become a little bit more certain. In other ways, it's also become a lot more uncertain. So it just feels like a gradual easing in interest rates here in the UK.
So what about your front end rates views now? You've said that there was a bit of a dovish tilt to the minutes. Has that changed very much following the meeting?
No, we haven't changed our view, and I don't think the risks around that have shifted materially. We still think a quarter point cut in interest rates, both at the August meeting and at the November meeting. Front end pricing is pretty much there already, sort of 50 basis points by the end of the year. They priced in a little bit more, but not significantly. Terminal rates expectations still seem a bit dovishly priced to us at 350. We have 375, but if the labour market data in the UK continues to deteriorate at the sort of same pace as we saw in the last set of numbers, which I think is actually an important point for UK markets to try and digest over coming weeks, then rates will come down a little bit more quickly. But we're just thinking that they don't need to do that in short order. Maybe it's a theme for 2026, but at the moment, front end rates up until the end of the year look pretty fairly priced to us.
So obviously we can't forget that Paul's also an expert on currencies. So let's move to the currency as well here, Paul. What is your thinking around sterling as well following the meeting?
Yeah, I think following the meeting, I think that it's just ever so slightly positive for the currency. I think some people would have thought that you'd get a much more dovish reaction from the MPC, given that the data that we discussed last week, we discussed the weaker than expected employment and GDP data, that maybe that would translate into a more dovish sounding Bank of England, and it really didn't. I know that we had slight moves in front end rates, but nothing too dramatic. For me, one of the key moves has been this decline in sterling euro. The euro's been outperforming sterling since we got that weak economic data. So the last couple of weeks, actually, sterling has been weak on the European crosses. And as I went through last week, I still think that those data come with a real sort of health warning, like handle with care. The employment numbers were sort of inconsistent with other measures of the labour market. The GDP numbers, the breakdown certainly looked odd from the way we're looking at it. And so I think ultimately the data might be revised, but we're going to have to wait for that. So we're recording this podcast on Thursday. On Friday, we've got retail sales numbers tomorrow. That might give us a better steer on the currency, but I think we'll have to wait for potential revisions next month to the labour market data, and less so the GDP numbers, before sterling takes back some of the losses that it's sustained recently.
And I suppose zooming out a little bit and thinking about the rest of the world, there's obviously been quite a lot of focus in the Middle East and rising tensions there with potential US involvement in the Iran and Israel conflict. How are you thinking about this and the market's views on this as well going forward?
Yeah, so I think it's clearly the most important news that we've had over the last week or so, and it demands attention, and rightly it's important for financial markets as they digest both the short-term and long-term implications of how things are developing. I would think that the initial reaction when we came in on Monday morning seems fairly constrained, maybe a little bit more modest than we perhaps would have expected. Maybe that's because of the shifting sort of export-import dynamic of the US economy over 10 years. The US is now oil exporter rather than an importer, and also the oil price hadn't moved very much because at the beginning at least, the flow of oil from the Middle East hadn't been impacted, and so I think that's one of the key transmission mechanisms into financial pricing, inflation, for example. I think as we look forward, I think markets are trying to work out the implication if there's escalation in the Middle East in terms of US involvement, because that would just simply increase the possible outcomes of the situation. And from a relatively constrained, limited set, I think that leads to a greater risk premium. If there's more outcomes, there's more uncertainty, and that tends to weigh on risk assets like equities. The dollar actually was really quite an interesting reaction, because recently the correlation, the sensitivity of the dollar to falling equity markets is sort of loosened. So equities markets fall, the dollar fell. But when equity markets fell this time on geopolitical tensions, the dollar actually rallied, so in line with its traditional risk correlation as the global reserve currency. So I'll be watching the oil price very carefully, but also the dollar as well as a risk proxy.
Well, that's interesting, Paul, that you say that on the FX market and on the market in general. I think for markets, there's a couple of things that are important. I think, from an economics 101 perspective, when we think about oil shocks and supply side shocks, the first hand impact tends to be on a negative growth. So we see a big impact on growth and rates rallying. But I do think that what's interesting this time around is I think that markets, to some extent, have learned and become a bit scarred perhaps by the Russia-Ukraine crisis that we had, where, of course, energy prices increased and inflation turned out to be a little bit more sticky than expected. So maybe I think the playbook has changed a little bit. And of course, markets are paying a lot of attention to oil prices and to what's happening with the Hormuz Strait. And that's because the inflation angle is important here as well. In the euro area, inflation has reached 2%, but clearly there's some more stickiness in the data in the US and the UK, for example. So that stickiness of inflation makes it a bit difficult for markets to be solely fixated on the growth impact from the energy price shock, if there is one. So I think that for me, markets are to some extent undecided, but also will have to wait and see in terms of what the full impact is. And clearly, the potential US involvement also opens up a range of possible outcomes.
And so obviously the US, in the context of the Middle East, has been the focus for financial markets. But We also had a small decision from the FOMC and the Fed. I was just wondering what you made of it and what our US colleagues thought the implications were.
Yeah, so I'll step in for the US this week. So hopefully I'll do a good enough job here. But I think that on balance, our US colleagues thought that the Fed meeting yesterday was essentially quite balanced. The FOMC delivered essentially what was expected, with the Fed rate remained steady and the dot plots not showing any change. I suppose markets were a little bit undecided on whether we'd see a shift in the Fed median policy dots. And I think what did happen was that there was no change. But it seems to me like there's quite a fine balance and quite a range of opinions within the Fed about what exactly will happen. And I think that that really speaks to that tone of uncertainty that we have from the Fed. Powell did note that uncertainty has reduced since the last meeting. And of course, we had an escalation in tariffs before the meeting and a de-escalation after the meeting with the China negotiation that had helped. But I definitely think that the tone is still that there is uncertainty. We of course had U.S. data earlier this month that was better than expected. But I think that similar to our view, we think that the Fed should really have more time and will need more time to assess the U.S. data before shifting tact too much. And Powell himself sort of highlighted that they will be learning more about tariffs in the summer. And I think that that is important. I mean, I think in my mind, the fact that we haven't seen an impact from tariffs doesn't mean that there won't be an impact from tariffs. There's still a pretty high effective tariff rate that is yet to be reflected in the data. So we still have to wait to see how that pans out. And I think that that bodes pretty well with our team's view, which is just that the Fed should remain on pause for this year, given that in our inflation expectations and our inflation projections, we still have a number that is elevated and above 3%, so clearly not in line with the Fed's 2% target. And one final notice before we end Bondcast for this week, we've covered in a separate thematic Bondcast a European rate special where we talk about our views on BTP and OAT spreads. For long-time listeners, you'll know that we've been quite positive on BTPs for quite some time now, just because I think really we are in a regime change when it comes to spreads. Politics is different, European unity is different, and debt is different than it was in the past. So our view essentially is that we should see BTPs and OATs compressing and essentially the spread getting to zero. And there's two reasons for this. Firstly, I think that markets are underappreciating the political impact and the political risk to come in France after the summer. We need to think about debt, a potential motion of censure, whether a budget can even be passed. Whilst in Italy, I think that the progress is looking quite good. Meloni is a politician that is able to intermediate between the US and the euro area. Debt is obviously still an issue, but a lower impact one at this stage. And lastly, crisis risks seem a bit more muted, and European unity is clearly quite high in a period of political uncertainty from the US. So we covered those views a bit more in our thematic Bondcast special, so definitely check that out if you are interested. But that's it from us this week. We hope you enjoyed this podcast, and if you did, please don't forget to follow and like as well.